Namaskar dosto, welcome back to the Stock Info. Today we are going to discuss one important subject in our episode 24. How many stocks you should actually own? The science of diversification. Bajaj Auto buyback. Bajaj Auto buyback record date 24/6/24, rupees 5,633 crores returning to the investors. Where does it go? The Bajaj Auto buyback. The genuine excitement. This was happening as the viewers watch us. June 24, 26 is Bajaj Auto buyback record date. Rupees 5,632 crores is being returned to the shareholders at rupees 12,000 per share, the largest buyback in the company's history. The stock fell 3% as it went ex-date, and for every investor who receives that buyback money in July, the question immediately becomes, where does this money go next? Back into the Bajaj Auto, into the different stock, into 5 stocks or into 20 stocks. That question, how many stocks you should actually own, is what every serious investor eventually faces. And there is science backed answer. Not 1, not 50, not whatever number feels comfortable. The specific range backed by decades of portfolio research. Today I give you that range, that framework to fill it, and a live portfolio builder in screener.in. This is the episode 24, the complete portfolio diversification guide. The two dangerous extremes. Both extremes fail for different reasons. Most retail investors make 1 or 2 mistakes with portfolio size. Extreme 1, too few stocks, 1 to 5 holdings. This investor has conviction in the picks. Sometimes they are right and the gains are spectacular. But when the holding hits the cash flow traps from episode 23, an inventory turnover collapse, a receivable days explosion, the OCF profit divergence, the profit has no protection. The single bad holding can destroy years of gains. Extreme 2, too many stocks, 50 or more holdings. This investor believes they have eliminated risk through sheer number of names. But with 50 stocks, they cannot manage meaningfully track the quarterly results, the annual reports, disclosures in the cash flow changes for each one, and mathematically at 50 stocks you have essentially recreated the Nifty 50, but stock picking costs, brokerage and tax friction on every rebalances. The expensive index fund with all the divergent disadvantages and none of the simplicity. Both extremes fail, and science points to the middle range. Now in section 3, this science of diversification, deliver with a genuine intellectual authority. This is the professional knowledge layer. In 1968, researchers Evans and Archer published a foundational study on the portfolio risk. They tracked how portfolio volatility fell as more stocks were added. The finding was dynamic. From 1 stock to 5 stock, risk dropped sharply, very significant improvement. From 5 to 10 stocks, still meaningful improvement. From 10 to 15 stocks, still beneficial. From 15 to 20 stocks, modest but meaningful. From 20 to 50 stocks, almost no incremental risk reduction. The curve flattens sharply around 15 to 20 stocks. Why? Because beyond 50 to 20 stocks, you have captured most of the diversifiable company specific risk. What remains the market risk? The risk of being in equity as an asset class which no number of stocks can eliminate. For an Indian retail investor, tracking their own portfolio part-time, 15 to 20 stocks is the professional sweet spot. You can meaningfully track each company through quarterly results, annual reports, changes and cash flow shifts. You have true diversification and you are not recreating the expensive Nifty 50. Now coming up, how fill those 15 to 20 slots across all the right sectors. The episode 19 sector map now applied to your actual portfolio structure. Sector diversification. connect especially to episode 19, reward loyal viewers with the applied version. In episode 19 I gave you 4 sector types: defensive sectors like FMCG, pharma, consumer staples; growth sectors like IT services, specifically specialty chemicals, quality mid caps; cyclical sectors like metals, auto, cement, real estate; and rate sensitive sectors like banks, NBFC, and housing finance. A well diversified portfolio should represent all 4 categories because they do not all move together. That is the entire point. When IT stocks crashed and then Accenture guidance cut last Friday, pharma and FMCG held steady. Today, Nifty IT is recovering while metal is under pressure. This is the sector rotation working in the real time, protecting diversified portfolios. The 3 practical rules that for a sector balance. Rule number 1, no single sector above 30 to 35% of your portfolio. Rule number 2, always have at least one defensive stock, the shock absorber. Rule number 3, cyclical exposure should be sized smaller because timing cyclicals currently is difficult for even professionals. Total 14 to 16 stocks, add 1 to 2 high conviction special situation holdings for your 15 to 18 stock portfolio. Always review every quarter. The position size rules. The most practically actionable section, Bajaj Auto as the live example. Now the critical question, how much of each stock? Bajaj Auto went exit for 12,000 per share buyback. Imagine the investor who had 30% of their portfolio in Bajaj Auto. Even if they gain on the buyback tender, they now face a position size problem. The 30% concentration means one corporate decision, one management change, and one product recall, one regulatory action could permanently impair a third of their net worth. The position size rules are simple. Rule number 1, single stock about 10 to 15% of the portfolio. Conviction positions can be 10%, an exceptional conviction can be 15%. Above 15%, you are making concentrated bet, not a diversified investment. Then rule number 2, equal weight as the starting point. Rupees 100 invested means roughly 6 to 7% of the stock in 15 stock portfolio. Adjust from equal weight based on conviction and valuation, but never let one position drift 20% and above. Rule 3, rebalance annually. When one stock has run up and now represents 20% of the portfolio, trim it back. Not because the business is bad, because the concentration risk has crept in silently. Now in section 6, live portfolio builder demo on screener.in. Open screener.in live. Build a sample 15 stock diversified portfolio in real time. Let me show you live how to build and check a diversified portfolio on the screener.in. I will build a sample 15 stock portfolio framework using the sector map we just discussed. This is for illustrative purpose only, not specific stock recommendation. Live demo of building and checking the diversified portfolio on screener.in. Type screener.in Google browser. This screen, desktop of screener will appear. Go to this watch list view. Here you can see core watch list. Click on this core watch list. Create a new watch list here. Now you can do my diversified portfolio. You give this name, save it. Now you have to add companies here. What you have to do, you have to see the companies manually, whether the results are good, and then make a note of it and add it here. Then first you have to go to the screens, see for sectors. There are a lot of sectors. As per our episode 23, we have identified 4 important sectors. The one is defensive sector, where FMCG stocks are there, FMCG and chemicals. Then comes IT sector and cyclical sector, and NBFC or bank sectors are there. First we will see this diversified FMCG sectors. Go to this FMCG sectors. You can see a lot of companies here. You have to check manually. Press on Hindustan Lever Limited. The market capitalization is 5,07,077 crores. Go to this cash flow section. See last 5 years it is positive. Yes, from 5,077 to 9,667. It is positive, very good. Then see the ratios here. Debtor days is 23, it has 19 days only. This is also very good. Then click on profit and loss. See the net profit for the last 5 years. It has from 7,999 crores to it has doubled 5,059 crores. This is a very good company. They identify this company, we'll add it later. Then again go to this menu. Next we'll see Nestle India here. The capital market capitalization 2,66,599 crores. Go to cash flow section. See last 5 years cash flow here. 1,505 to 4,221, it has doubled. Cash flow is very good here. See the ratios. Here. It is only 5 days. The collection period is very good. The company gets its item, his stock sold and gets the collected. The debtors are collected within 5 days. This is very good performance by the company. Then go to this profit and loss account. See the net profit for the last 5 years. 2,188 crores to 3,545 crores. This is also very good. So you identified this company also. We'll add this to the watch list. Then go to the third company. You can see this Britannia Industries here. Britannia Industries, the market capitalization is 1,26,746 crores. Go to cash flow section. See last 5 years cash flow. 1,611 to it has come to 2,408 crores. See the debtor days. Debtor days is only 9 days. This is very good. And then go to this profit and loss account statement here. We can see the profit is positive for the last 5 years. In the last 5 years, we can see 1,851 crores to 2,537 crores. This is very good. So we can add this also to our company. And lastly, we can see that Colgate-Palmolive, you have very heard of Colgate toothpaste. This is a very good company here. So market capitalization 50,453 crores. Go to this cash flow section. See the cash flow for the last 5 years. 727 to it has become 1730. 2.5 times it has increased. This is very good. And the ratios, debtor days, it is only 13 days. This is also very good. Then go to profit and loss section. See here the net profit for the last 5 years. 1,078 crores to 1,325 crores it has improved. This is very good. Yeah, we have identified 4 companies here. Then now we will add all these things here. Go back here, go to this, click on the screener, again desktop will come. Go to this watch list view, core watch list, click on the diversified portfolio or portfolio has come. Then click on the companies here, then add companies, it is asking. First we have saw Hindustan Unilever Limited, it has been added. Then we have saw Nestle company we have added here. Then what we saw Britannia and Industries, you can add here. Then lastly Colgate-Palmolive India. We have added all the four you have seen here. If you click done, see your watch list is ready. It is started with 4 companies here. You can add or delete anything depending on your depending on the company's performance at any point of the time. In this way you can create a portfolio in screener.in. This is one. Then I will show you the another sector, IT sector. Go to screens here. Then go to IT sector here. IT sector software. Click on this IT sector software here. You can see TCS. Click on the TCS. Click on the market capitalization is very highest, 7,60,851 crores. Go to cash flow section here. See the free cash flow for the last 5 years. It's very positive. 36,000 crores to 48,000 crores. It has increased. Ratios. This 93 days debtor collection period. Go to profit and loss account. IT sectors, it will be like that only. No problem. Then go to the net profit section. Here for the last 5 years you can see good profit growth. You can add this TCS to our core watch list. Then we shall see the Infosys. You have heard of Infosys. This is very good company here. Market capitalization 4,28,628 crores. 620 crores and ratios. You can see the ratios here. It's 72 days. Then FCF, free cash flow for the last 5 years. It's very good. Positive. Then go to profit and loss section here. In profit and loss section, see the net profit for the last 5 years. 22,146 crores to 29,470 crores. So add this to watch list. Like this, HCL technology is also very good. You can see 3,02,166 crores. Cash flow is positive for the last 5 years, 15,345 to 18,597, and the debtor days are 66, comparatively very low when compared to other sector, previous two IT sectors. Then profit you can see net profit for the last 5 years, 13,523 crores to 16,652 crores. This is very good. So we can add this also, TCS, Infosys, HCL Technologies, and lastly we can add LTM also. LTM results also very good. Now what you have to do it is go to the screener, go to this watch list again, then core watch list, select our my diversified portfolio, then companies, click on the companies here. You can add companies. First we shall add the TCS, okay, then Infosys Limited, then what you have seen, HCL Technologies we've added, then LTM we have added here. Now press done. You can see all the 8 companies has been added to our portfolio, diversified portfolio list. Like this, you have to add another 2 sectors, cyclical sector, NBFC sectors, and keep watching about these things. You can delete any company or add any company during the course of time depending on your needs. That is about creating a diversified portfolio list in screener.in. Section number 7. Now the rebalancing calendar and action plan. The complete close, every prior episode referenced, genuine sense of completion, your portfolio action plan. Step 1, count your current holdings. If it is below 10, you are under diversified. If you are above 25, you have work to do trimming. Step number 2, map each holding to one of the 4 sections types from the episode 19. Step number 3, check sector weights. Any sector above 35% needs trimming and selective addition in other sectors. Step number 4, check position sizes. Any single stock above 15% deserves the conversation with yourself about whether the conviction warrants that risk. Step number 5, run an episode 23 5-step check for your 3 largest holding this week. The Bajaj Auto buyback today returns 5,632 crores to the investors for anyone who participated. That capital needs a new home, and the framework decides the new home, the 15 to 20 stock structure, the 4 sector types, and the 5 cash flow trap checks. The intrinsic value calculation is now complete. Yes, this is the 24th episode of the series, from the reading a balance sheet in episode 1 to the building the complete research backed, forensically checked sector diversified portfolio today. Comment below how many stocks do you currently own and which sector is well represented. I reply to every day. Share this with investor friend. Follow. We keep building. Please subscribe, like, share with your family and friends, and please support me to bring more such good videos for you. And thanks for watching.